This is Sunday, February 22nd, 2026. Shanghai's silver vaults just collapsed, from 3,091 tons down to 353 tons. That is an 88% drain in 30 days. Gone. Emptied. And at the exact same moment, silver on COMEX just closed Friday's session at $84.57 an ounce, exploding nearly 9% higher in a single day. Let me say that again so it sinks in. The vaults are almost empty, and the price just exploded. Both of those things are happening at the same time, and I need you to understand why that combination is the most dangerous signal this market has produced in decades. If you are watching this and you think that sounds normal, I need you to stop, take a breath, and watch this entire video, because what I am about to show you does not make any sense. The numbers do not add up. The story the mainstream financial media is telling you is not the real story. Something else is happening, something much bigger, and by the end of this video, you will understand exactly what it is. Pay very close attention to these numbers because they are going to matter. COMEX registered silver, the silver immediately available for physical delivery in the United States, has now fallen to approximately 82 million ounces. In 2020, that number was over 300 million ounces. That is a 73% collapse in 5 years. The London Bullion Market Association, the LBMA, has lost roughly 40% of its vault holdings over the same period. And now, Shanghai's exchange inventories have collapsed 88% in just the last 30 days alone, from 3,091 tons down to 353 tons. That is the lowest level recorded since 2016. 3 of the largest silver storage systems on the planet are draining simultaneously. Does that make sense to you? Does that sound like normal market behavior? Something is very wrong, and I'm going to show you exactly what it is. A few weeks ago, I made a video. In that video, I told you that the arbitrage gap between Shanghai silver prices and Western COMEX prices was widening in a way that suggested massive physical demand was building in the East. I told you that the COMEX delivery data for the February contract was showing a 98% physical delivery rate, meaning almost nobody was rolling their contracts forward. Almost everyone was demanding real silver. I told you that was a stress signal. What I did not expect was how fast it would accelerate. I did not expect Shanghai vaults to drain 88% in a single month. I did not expect silver to rip $7 in one session. I did not expect China to simultaneously announce export restrictions that effectively locked Western buyers out of the world's largest silver supply chain. All of that happened. And that is exactly what we need to talk about. Here's what you need to understand about the silver market, because most people do not understand this, and that misunderstanding is costing them money. There are 2 silver markets operating right now. There is the paper market, futures contracts traded on COMEX in New York and on the LBMA in London, where banks and institutions trade pieces of paper that claim to represent silver. And then there is the physical market, actual, real, tangible silver bars and coins that you can hold in your hand. Under normal conditions, these 2 markets track each other closely. The paper price and the physical price stay within a few percent of each other. But right now they are breaking apart in a way that has no modern precedent. The paper market closed Friday at $84.57 an ounce. Meanwhile, in Shenzhen, China, buyers are paying $93 an ounce for physical silver. Sprott Money in Canada is offering physical silver at $91 an ounce. On January 1st of this year, when COMEX futures were showing $72 per ounce, physical dealers in Japan and the UAE were selling silver, when they could even find it, at $130 per ounce. That is an 80% premium over the official paper price. The paper says one thing. The real world says something completely different. The paper market is like a giant poker game, where everyone is betting with chips that represent gold bars sitting in a vault. It works fine, as long as nobody actually asks for their gold bars. But right now, people are asking for their silver, and the chips are not backed by nearly enough real metal. Now let me tell you what is driving this, because this is perhaps the most important part of the entire video. On January 1st, 2026, China implemented new export restrictions on refined silver. Starting that day, only large state-approved companies with annual production capacity of at least 80 tons and verified credit facilities exceeding $30 million are permitted to export silver. That single policy change effectively shut out hundreds of smaller Chinese exporters who have historically supplied global industrial buyers and Western refiners. Only 44 companies in total received authorization to export silver for 2026 and 2027 combined. China produces and exports roughly 120 million ounces of refined silver per year. That supply is now controlled, restricted, and directed internally. Let that sink in. China just cut Western buyers off from one of the world's largest silver supply arteries, and almost nobody in the mainstream financial press covered it. Here's where it gets more alarming. While China is restricting silver exports and draining its own vaults to historically low levels, the People's Bank of China has simultaneously been buying gold for 15 consecutive months without a single pause. The PBOC has added over 300 tons of gold to its reserves in that period. So China is restricting silver exports, draining physical silver vaults to decade lows, and aggressively accumulating gold reserves at the same time. American and European institutions, meanwhile, are trading paper contracts on COMEX that are backed by a fraction of the physical silver those contracts claim to represent. One side is removing real metal from the system. The other side is playing a video game with paper claims. One side is taking home the prize. The other side is holding a receipt for a vault that is getting emptier every single day. Let me show you the COMEX data because the numbers here are extraordinary. As of February 5th, 2026, COMEX March open interest, contracts demanding physical silver delivery, stood at 429 million ounces. COMEX registered silver available for delivery stood at approximately 98 million ounces at that point, and has since declined further toward 82 million ounces. That is a 5-to-1 ratio of paper claims to physical metal. In any other commodity market in the world, that would be considered a crisis. If you walked into a bank and they had loaned out 5 times the deposits they actually held, we would call that insolvency. We would call that a bank run waiting to happen. On COMEX, they call it Tuesday. But February 27th is first notice day for the March silver contract. That is this coming Friday. And the delivery rate on the February contract was 98%. Meaning almost every single contract holder demanded real silver instead of rolling to the next month. If March follows the same pattern, COMEX will face a physical delivery demand it mathematically cannot meet with the registered inventory it currently holds. Let me connect all of this together for you, because individually each of these facts is alarming. Together, they tell a story that is impossible to ignore. Shanghai vaults down 88% in 30 days. COMEX registered silver down 73% from 2020 peak. LBMA vault holdings down 40%. China restricting silver exports. PBOC buying gold for 15 consecutive months. Physical premiums running 10 to 80% above paper prices, depending on geography. February COMEX delivery rate at 98%. March first notice day arriving in 5 days. Every single one of these data points is pointing in the same direction. What we are witnessing is the slow-motion separation of the paper price discovery system from the physical reality of where silver actually is and who actually has it. Some people will say this is conspiracy theory. They will say COMEX has never defaulted. They will say the system has always found a way to settle. To those people, I say, look at the evidence. Shanghai vaults down 88%. COMEX down 73% from peak. Physical premiums at 80% in some markets. China restricting exports for the first time in modern history. A 5-to-1 ratio of paper claims to available metal heading into the largest delivery month of the year. That is not conspiracy. That is data. That is facts. That is reality you can verify yourself with a 5-minute search of public COMEX depository reports and Shanghai exchange filing. Let me show you the bigger picture, because what is happening today did not start today. The drain on Western silver vaults began in early 2021 when retail investors organized on Reddit and coordinated a physical silver buying campaign. In 8 days in February 2021, they pulled more physical silver out of the COMEX system than had been delivered in the previous 12 months combined. The system survived that event, but it never fully recovered. The registered inventory never climbed back to pre-2021 levels. Instead, it continued declining, slowly, then faster, and now it is accelerating. The bathtub has a drain in it, and the drain has been open for 4 years. What is happening now is not a new problem. It is the same structural problem that was exposed in 2021, finally reaching its logical conclusion. You cannot run a paper silver market backed by a fraction of real metal indefinitely. Eventually, the metal is gone, and the paper is all that is left. Now let me tell you what I believe happens next. I believe the March 2026 COMEX delivery cycle, which begins this Friday, February 27th, will force one of 3 outcomes. Either COMEX raises margin requirements so dramatically that most contract holders are forced to close their positions before delivery, which would temporarily suppress the paper price while doing nothing to solve the physical shortage. Or COMEX allows delivery to proceed and is forced into emergency cash settlements for contracts it cannot fill with physical metal, which would be the first open admission that the paper market is not backed by real silver. Or, a major dealer or bullion bank quietly announces force majeure on silver delivery obligations, triggering a cascade of counterparty failures across the LBMA and COMEX simultaneously. I am not saying any one of these is certain. I believe we are approaching the breaking point where the market is forced to choose. The question is not if this resolves. The question is when and which of these paths it takes. Now, there are three types of people watching this video right now. There are people who already hold physical silver and are watching this with a mix of vindication and anxiety. There are people who have been watching the situation develop and are wondering if they missed their window. And there are people who are hearing all of this for the first time and do not know what to do with it. Which type are you? Now let me tell you what this means for you, because I am going to be very direct, no sugarcoating. If you are holding paper silver, ETFs, futures, unallocated accounts at a bullion bank, you are holding a claim on silver that may or may not exist in the quantity stated. That is not speculation. That is what the vault data shows. If you are holding physical silver already, the data suggests the structural case for significantly higher prices is strengthening, not weakening. The arbitrage between Shanghai and New York is not narrowing. It is widening. If you are looking to acquire physical silver right now, understand that the price you see quoted on financial websites is the paper price. The physical price in the real market is meaningfully higher, and in some geographies, dramatically higher. Do your due diligence on premiums before you act. The paper price of silver crashed repeatedly in the first weeks of 2026 as institutions sold futures contracts. During that same period, Shanghai vaults drained 88%. COMEX registered inventory fell toward decade lows. Physical premiums expanded to 80% in some markets. China restricted its silver exports for the first time in modern financial history, and the People's Bank of China bought gold for its 15th consecutive month. The paper said one thing. The physical world said something completely different. One of those is a lie. And it is not the 353 tons sitting in Shanghai's vaults. It is not the empty shelves at dealers from Tokyo to Dubai to Toronto. This is what a structural market breakdown looks like in real time. It does not happen overnight. It builds slowly, then it happens all at once. If you have found this analysis useful, subscribe and turn on notifications, because the next 30 days are going to matter enormously, and you need to be watching when they do. Leave a comment below and tell me, do you hold physical silver right now? And what is the premium you are being quoted in your country? I want to know what the real market looks like on the ground where you are. That is not a market operating normally. That is a magic trick running out of room. And now you know how the trick works.